Okay, people are coming in. Hey, good morning, good afternoon. We're going to wait just a couple of minutes and get kicked off to the US Tariff Policy and potential impact on M&A. Thanks, everybody, for joining today. If you have any questions throughout the session, and I'll reiterate this in a minute, please feel free to stick them in the chat, and we'll get to as many as we can. We do have some questions that have been sent over. Thank you in advance for some of the participants. So we'll get to those as well. So we'll just give it another couple of minutes to get started. Give it another minute. Okay, it's coming up on 10:32. We'll probably have some late joiners, but I'm going to go ahead and get us started because we've got a limited amount of time together today. Welcome to the U.S. Tariff Policy and Potential Impact on M&A. This webinar is brought to you by the M&A Consortium. It represents best-in-class PE-focused service providers working collaboratively to drive value into portfolio companies. My name is David Harvey, and I work for ContinuServe, a member of the consortium. And my focus is bringing value to PE firms and their portcos to support various methods of value creation. And our distinguished speaker today is Dr. Michael Ewings, Professor of Finance and co-director of the Private Equity Program at Columbia Business School. I want to reiterate, I encourage you to put questions into the chat that you might have as we go through this session so we can try to get to as many as we can. I did mention earlier, we do have some that we've gotten in advance. But let's get started. Welcome, Dr. Ewings, and thank you for taking the time out of your busy schedule to visit with us today. First, if possible, I would just like to get some general thoughts from you about the present environment that we're facing for PE firms and their portcos and the current and potential activity moving forward, given the wild ride that we all have been on the past few weeks.
Sure. Well, thanks for having me, and thanks everyone for being here. Some sense I wish we weren't here today for this type of discussion, but I am glad we can talk about it. And I also hope, again, questions are important. As with teaching, I often learn a lot from folks I'm teaching, and I think in this case, folks I'm interacting with in the audience. I think what's important about what's happening right now is I think we have to think of this primarily as a change in uncertainty rather than a change in tariffs right now. I know the policy, the last change in it was a sense that there was at least a minimum of 10% on most countries, with some exceptions. But I think the first order change that I've focused my energy on thinking about impacts has been on increased uncertainty. Given the role of global manufacturing, global trade in nearly every major business in the United States, and I think that particularly holds for private equity, a change in uncertainty and an increase in uncertainty is bad. Now, what does that mean for a business? It depends on everyone in the room. Probably has their own sense of what uncertainty means for them. But I think the simplest framing for this is how I've often taught corporate finance, which is thinking about uncertainty as of increasing the option value that you have of delay. So any project you have, if there's a lot of uncertainty and you have a big investment to make, factory, closing a deal, you're almost always better off simply waiting. And I think we can all agree that waiting in private equity has lots of costs. You have a fund that has a limited life. You have LPs that are thinking about IRR. You have operating partners who'd like to move to a different deal instead of focusing on this one. You have value creation plans that underwrote 5 years, not 10. That as a whole has nothing to do with tariffs per se, but has everything to do with uncertainty. On the tariff side, I think we can all understand the direct impacts. Depends on the business, depends on how your inputs are facing, depends on your competitors. But it's generally bad news for the economy, in that I like to think of economies have optimized themselves for a situational input-output structure. And when you introduce what is effectively a large tax and a broad one, across all parts of the input and output side, it simply requires firms to adjust and adapt, and that's costly. I'm not going to make statements. I'll end here on the sort of the longer term policy goals, right? Industrial policy, trade. That is a big question that I think we don't really understand the goals, to be honest. And so I think it said thinking a little bit more short term is important. I have a lot more to say, but I want to get to the questions as best, or of course, whatever you think we should do, David.
Sure, no, definitely. Do you and this is several of these questions that came in were duplicated, but do you think that the current environment, the uncertainty, is going to actually help push the Fed to potentially cut interest rates? I know it's been a lot of conversations. You know, late last year they were talking about, oh, we're going to be facing potentially or seeing more cuts coming, and then as we've gotten into this year, that's kind of been tamped down. So just wondering what you think there.
Sure. So first thing is just the questions economists don't love to get are, where should I put my money in stock market? And the answer is index funds. No one wants to hear that. But the other thing is predicting things. I don't want to predict, but fortunately in this situation, I'll put in the chat a couple of useful resources for folks. The CME Group and JP Morgan has a nice summary. I'll just put that there. The Fed and its board is asked questions about where they think policy and rates are going. And the changes that have occurred over the last month suggest there are more cuts expected than there were a few months ago. So I will form my expectations on that. I think the Fed is likely balancing lower economic growth against inflation. And I don't think inflation is likely to be as big of a deal. Tariffs tend to do is they create shifts in price levels, but they don't necessarily change the rate of growth unless it gets more complicated. And I just think it's too messy right now. So my belief based on this type of statistics is that the Fed envisions at least weekly more Fed cuts in the next 12 months than they did months ago. So I from a financing perspective, that's good. But the reason this is happening is not good news, right? It's because of concerns about growth.
Right. Do you think, typically when you see rates start to move down, a lot of private equity firms, especially the larger ones, have been holding on to their powder, and they're not making investments because the cost of leverage buyouts are just extreme. And you mentioned the 5 to 10 year window, the deal exit plan. Is that possible that might actually increase some activity and people will start kind of freeing up some of their assets to do this, or is it likely to be more of a wait and see approach?
Yeah, I think in principle, yes. Lower rates historically have provided the grease or lubricant one needs to get this market going. There's another issue which recently was released in Bloomberg about KKR. I can send the article over soon. But the counterpoint to that is what's happened over the last couple of years in private equity is rates have gone up. We all experienced the 22, 23. And yes, deal flow fell, inflows to funds fell. But my experience of this has been that I think the industry's been quite resilient to higher rates. It's meant bigger equity checks. It's meant slightly different kinds of targets, right? Because you have a bigger interest burden. But I think this industry isn't as sensitive to, a percent, 100 basis point change. I think the growth prospects are more meaningful for doing deals than the marginal difference. Last night I was teaching a class on value creation, and a speaker was talking about a case, and they had a lot of financial covenants. They paid 5% instead of 7%. And they looked back and said, look, if I could do my way, I would have just taken 7%. So I don't think the average deal in private equity is that close to having, I wish it was 6%, not 7%. So I'm more optimistic that the deal flow isn't that sensitive.
Do you think that that it's actually possible that there's been more and more push over the recent years of making private equity type investments more available to the public through funds, things like that. I mean, it almost sounds like that private equity is a slightly more insulated than some of your other funds. I mean, do you think that this might actually influence some of that activity to maybe move some people into what they used to consider more risky into something that really seems to be less?
Great question. This is a big academic debate about whether private equity as an asset class, including venture capital, is less risky or has lower volatility. I don't want to get too much into that debate. There are some strong opinions on that. But no part of the debate is that part of this is just simply not marking the portfolios often. Now, whether that's a good or bad thing, some investors want literally to buy and hold, and they don't need to have a daily mark. So in that sense, yes. However, the bulk of capital in private equity comes from large institutional investors, right? The pension funds, insurance companies, family offices. And those folks, most of the time, are sophisticated enough to implement targets for their private equity allocation. And a reason for that is simple. When I invest in PE, I'm basically taking on a liability of capital calls, and I need to be careful. So that means that the sensitivity to allocations is coming from these folks and their targets. And this is where the denominator problem comes in, where if public equity markets fall, they're more likely to be above target on PE because the valuations haven't fallen. So my sense is that this is going to, if anything, pull back private equity as a macro level. But to your point, I think it could impact retail investors' willingness to invest, and step in a little bit.
Interesting. Going back to kind of just the general tariff, discussion, there's been this, kind of temporary pullback to where we're going to this kind of 10%, and we're going to give people 90 days, less than that, obviously now, to, come to the table, negotiate, and hopefully, everyone ends up with a better deal, or, we end up with a better deal, what have you. Do you think it's really possible during this quote 90-day pause to negotiate deals with what they say is up to 130 different countries at this point? I mean, is that even a practical assumption or
Short answer is no.
not?
But as with most things, it depends how we define a deal. If we want to define a deal as a comprehensive agreement across services and product trade, which, to be fair, like this whole thing has been focused on goods trades. The US is killing it when it comes to service trade. We are like, everyone buys our labor in a way. I mean, I like direct labor, not our labor through production.
Sure.
So I don't think so. If you look back at the big trade NAFTAs, the TPP, which was pulled back, WTO is a version of a big trade agreement. Those things take a ton of time. And I'll if I was on the other side of this, which I want to stay. This country is amazing. I don't want to be on the other side of this. But if I'm Europe, I'm Canada, Mexico, I am not talking to this administration. I don't know what they're going to say the next day. I don't know if I can trust their agreements. So I just don't think that part is even going to make it possible in the next few months, unfortunately. So short answer is no, I don't think so. But deals could be defined as whatever the administration decides it is. It could be a tweet that says we are doing tariffs at 0 and now we've made a deal. Depends.
Yep, understood. Would you agree with potentially the statement that tariffs could potentially create an opportunity for both buyers and sellers, particularly those companies that manufacture in the United States, and those PE firms that are in maybe the middle to lower middle market that are not investing in international companies, that are their portfolio is pretty much domestic?
Yeah, I think there's a narrow set of firms who have portfolio companies that could benefit from this. If you are a manufacturer competing with an international, particularly Southeast Asia, or even Mexico, if those tariffs go through, you could benefit. I mean, to be fair, the reason you're benefiting is because the government has imposed a real cost on your competitors, which I'm not sure many of the free market types in PE is really the lever they want pulled. But it is indeed true. I will say, back to the uncertainty piece, I just don't know if those are the long-term strategy. So is this what we expect the world to look like for the next 5 to 10 years? I don't know. So I wouldn't bet on it being valuable. Now, the longer-term play of moving manufacturing onshore, that seems like a real opportunity if it sticks. And this is part of the IRA and part of the CHIPS Act that has been effectively shut down, which is ironic given the growth in manufacturing that
Right.
created. But I would say that I'm going to put another link in here. The opportunity is, this is from Bloomberg this morning. there are opportunities for funds like KKR, if it works out for them, where they have capital on both ends to take advantage of essentially a untested, difficult market, where if you're willing to move and buy when others are willing to sell because of these shocks, it can be pretty profitable, regardless of the industry. So in this article, they highlight that they're stepping up their COVID playbook and saying, look, this is it's like Buffett, right? Where he steps in when folks are trying to sell. And the reason KKR can do it, to the point about capital, is they're funding a lot of their own deals in the article. So I think what they're doing is they're using their private capital arm. There aren't a lot of firms that can do that, but it suggests to me that regardless of opportunity to whom and to what, financing seems to be a real challenge here. So even if you want to take advantage, KKR's strategy here is not available to everyone. And I worry that the financing capital markets aren't going to be there for you to take advantage in the near term.
Is it practical? I mean, do you think that the imposition of tariffs really revitalize domestic, production anytime soon? I mean, you're talking about a factory that takes time to build and anything like that. I mean, it seems like it's going to take a while if these have the quote desired effect. I mean, is it really practical to assume that it's going to revitalize manufacturing?
No, I'm an academic. Have I built a factory? No. But a way to think about this is almost everyone in the room has heard ERP, implementation of ERP. And how long do those take? 2-3 years in some cases? Or think about a classic private equity strategy of doing a carve out, right? How long does that take? Sometimes they're not even building a factory. All they're doing is buying a factory and giving it a CEO and separating it from the parent firm. I think we can all agree that that is less complex than deciding to buy land, getting permits, hiring a staff, putting in factories, finding customers, distribute, all the things that come along with building a factory. So in the near term, no. But in the long term, I want to be fair, I don't want to take a position on this. The US government has a policy that it wants to reinvigorate manufacturing. Fine. How to do that is not to simply raise the prices of competitors. Right? That is, I think, offensive to people who build factories. It is more complicated than that. And so it needs to be a well-rounded policy to really encourage people.
So I've got some questions that are starting to appear in the chat here. So I'm gonna hit a couple of them if we can. Upon the initial announcement of the tariffs, the impact on the US dollar relative to the currencies of net export heavy countries, India, for example, seemed to go in the opposite direction than what would have been typically expected. US dollar weakened slightly instead of strengthened. Can you help us to understand what might be going on there?
Sure. Looks like my internet's a little unstable, but I read the question. Yeah, the dollar impact has been weird. Normally you would think it, indeed, as the commenter stated, go the other direction. And I think what's happened is that there's two things have gone on. Well, three. One is this change in instability has led the world, investors across the world who have vested in US debt and equity securities, to step back and say our beliefs about the stability and safety of this country and its assets are not what we thought they were. So that lowers demand. Anytime price falls, just think lower demand, right? So because the supply's fixed. So we have a lower demand. So that's one. I think the other is the relative, even if you don't believe the US is sort of like much worse off, it does provide new opportunities outside of the US that make other currencies more valuable potentially. So it's a reorganization organization there. And then I think part of this is also, we don't know. There's very likely some large countries that are taking this in the background, in the plumbing, so to speak, and pulling back in ways that we don't understand. Relatedly, hedge funds and others that use a lot of debt in complicated ways. I think these big shocks to the markets have spillover effects in complicated ways in other parts of the financial markets. And I think that could also explain. And I think the Fed knows what's going on because it sees all the plumbing. But I think outsiders, the story is a complex trading of dollars because of reallocation of debt and bonds that I think could be driving this. I wish I could tell you exactly what it was, but it's weird. It is weird. And I'll be honest, it's unsettling. To me, the bond market and the weakness of the dollar, given the tariffs, is really worrying to me. I think what makes America great, among many other things, is that we have the reserve currency and we have the reserve, what I would call institutions. Like people just come here. I have all half my students from outside the US. They all have great opportunities on. They come here because we have like stability, we have institutions, we have freedom, and the dollar falling and bonds doing what they're doing is just worrying. Signals that that's not what people think anymore. Anyway.
Yeah. Kind of in a different lane here, but what levers do you think China could pull to swing an advantage to their way? Because there's been a lot of talk about rare earth and things like that. Curious about your thoughts on that.
Yeah, so preface this with I'm not a China expert. But on the rare earth thing, they have a more immediate lever to pull on that front. So I think that's fair. But what I have learned over the years as an economist is that when someone says, oh my gosh, we're running out of X, you tend to forget that there's a price system. And what those price systems do is they reveal, oh, wait, there are supplies in Montana. There are supplies in Arizona. And so things like lithium years ago were like, oh no, we're going to run out. We're not going to run out of lithium. These rare earth metals, I believe in Montana, because prices went up, folks were encouraged to explore and they discovered. So I'm less concerned about that doesn't mean the input prices won't go up, but I'm less concerned there. What China has, sadly, is what maybe where things are going from a federal perspective on policy, which is China hasn't. Yeah, I was revealing a little bit myself, but they're an autocratic country. They can move quickly and tell their citizens what to do. This gives them a power in a world of what the heck's going on. We want to move from X to Y quickly. They can tell people what to do, and that's a unfortunate power. And so I think that lever for them they can pull. But I think what we're seeing in the last couple of days is the other piece, is that while Europe, Southeast Asia doesn't really like a powerful China, they like certainty and they like agreements. And what China has the opportunity to do is step up and say, we will sign something, and we are better than this mess that's currently observing in DC. And they can do that, and they don't need votes. They don't need Congress. It's back to that. It's a dictator at the end of the day. And that's a power when you need to move quickly and take advantage of gaps. So
makes sense. There's another question in the chat. What is the current sentiment or regulatory outlook regarding tariffs on services delivered from offshore teams to U.S. customers? Might be a little difficult to answer.
Ooh, that is a difficult one, Ryan. But I think you might be hinting at some of the stuff that the EU has itself hinted at on levers it can pull to punish U.S. firms. While Europe doesn't export as much as we export to them, they have service connections to their firms that are based in Ireland and other places. But I'm not aware of this. I guess my current sentiment is everything's on the table in ways that we wouldn't expect. The joke I heard right when this happened the last week was this is one of the first times some of the European institutions were working on a Sunday to address Trump's thing. So at the very least, they've kicked weekend work into Europe that they didn't see before. So there's a lot of uncertainty on there.
So this is probably a pretty obvious question. How has tariff uncertainty affected deal making?
It has slowed everything I have heard and seen across the life cycle. It's slowed everything down. It's back to my original point is in a world where you have a large irreversible investment, like buying a company or doing an add-on transaction, in a world of increased uncertainty, your optimal strategy is to wait. And that's what almost all firms are doing. You could say, the economists would say, well, why not just lower the price, right? The seller should just lower the price. The problem is that uncertainty is so high, you don't know what the right price is anymore. You can't agree on a price. I'm seeing this from my students at the MBA level, is that hiring is slowed down. So people are pausing. And to me, that's a private equities firm long-term view on deal making, on fundraising is clear when they start making investments in people. Hiring one of my smart students as a VP is a signal that like we are committed to a fund for the next 5 to 10 years, and that's slowing down, and that's worrying.
So this would, I guess, taking this even a step further, is how does this translate into the actual portcos themselves, the portfolio-owned companies? Have the investments already been made in?
Great. That to me is one of the more immediate responses, and For that, I like to think about essentially think of it as what does it mean to be an owner of a firm in the face of tariffs and tariff uncertainty, but then narrow it and say what does it mean to be a private equity backed company during this time period. And I think we all know what makes private equity backed firms unique. They're levered. So starting there, increased leverage just increases the downside risk, and we're in a world with more of this volatility. So we have more likelihood of being in the left tail, and that's bad news. Right? That's one. Two, we mentioned delay. So if you're a portfolio company and well run by your private equity owner, you have been thinking hard about increasing your EBITDA and exiting. And if we're delaying things, it's going to be harder to implement value creation because we have to hold back resources. And then two, our exit plans just moved out a year, right? Or for example, so that's bad news. The other, I think, for private equity companies is that what I find private equity fascinating for lots of reasons, but they're really good planners, data trackers, and well, those are the two things. There are many other things. But what this means is when they're owning a firm, we all know they have a playbook. They have underwritten a 5-year value creation plan. They do usually not throw in a wrench in those scenario analyses of tariff uncertainty and tariffs. And in that world, these models, to be honest, are just not built for it. The fortunate upside here is private equity is very good at dealing with change, right? Dealing with change and responding quickly and making decisions quickly. So I think that is a superpower for two companies in the same industry. One's private equity, one's not. The weakness of the private equity is you've got a lot of leverage and you have this clock running. But the power is you have a private equity firm that knows how to deal with change and is going to be deliberate in it. And I think that could be a power in this case. But it depends. But
I would think that this would actually create even more of a need for value creation. There's going to be more of cost outs and things like that that a lot of these PE firms are going to have. How do you see us unwinding all this? Meaning, where do you think the chips are going to fall at the end of it? That's a loaded question, but
yeah, it's a little bit outside my expertise, but I think most governments, regardless of their political leanings or ideological position or grievances, if I may say, I think a lot of this has to do with grievance, are going to be disciplined by the economy and by markets. No matter what so my view on this is what do I think is going if it continues, what's going to happen to the economy, and then assume that the government will respond to that because they have no choice. So in that case, I think this has to end at some point in terms of the rates will be lower and there'll be pullback. Because I am confident that as it's going right now, a combination of uncertainty and historically high tariff rates and the lack of ability of our economy to adjust quickly, like as we talked about, this is going to be bad for growth, bad for deal making, bad for stock returns, bad for the bond, bad for the dollar. And again, it's not what I want to step back, is it is possible a tariff policy well constructed could not do those things. It could have been done in a way, careful, deliberate, planned, and it could have not destroyed as much value as it has. But as it's going, it will, I think. And therefore, I think this is going to get pulled back. There'll just be no choice. Unless this person in power really doesn't want a third term. I don't even want to talk about that. But if they're disciplined by politics, then this is bad news for whoever's in power. And that means they're going to have to pull back.
There's one other question. Are there any potential effects on software or SaaS specific companies? Might be hard to sort.
I think the short answer is yes. The tariffs have look. I think I hinted at this before. The U.S. one of the U.S. of many superpowers is what we provide from a non physical product space to the world. Our services and software. And this is where other countries can really punish us if they want to. Now, they have to do it at their own cost. So, for example, they could regulate the Metas of the world, the Amazon clouds of the world that are providing cross-border services. They could really, I don't know, I'm not aware of any of this going on, but this is a real risk, is that our weakness, in a sense, is our dependence on selling our services across the world. The challenge is I don't know how you implement those policies. They're really challenging because there's really no borders to this stuff. And we're benefit from the fact a lot of large and multinationals depend on our service providers and software providers. Europe would have to shoot itself in the foot in some sense, which is what I honestly think this policy is built on, is like, you want to hurt us, well, you're going to hurt yourself. So who knows what that brinkmanship looks like right now.
Right, totally understand. That is the last question in the chat. We're right at time, it looks like here. I can't thank you enough, Dr. Ewens, for this. It's been very, very interesting and great to hear your point of view on this. You're obviously very well in tune to this, and certainly for the benefit of our audience and the M&A consortium, we do appreciate it. And maybe we all need to take a class with you or something.
We do have some remote and custom programs available, but if you ever want to apply to the MBA program, most of you are probably past that. Happy to chat. This is a super interesting area, and if anyone wants to reach out to me, my email here, if I missed something or I was wrong, my students don't love to hear that I don't know something or I'm wrong, because they think I'm like, when I'm in the front of the room, I know everything. But I, as an academic, love to learn. So if you think I need to learn, get smart on something, there's my email. Please do not hesitate to reach out.
That's great. And thank you again. Appreciate everyone joining today, and have a good rest of your day. Thank you.
Bye, everybody.
Bye.
Thanks, David.
Thank you.